welcome to the deep dive. We're jumping into the fascinating world of Palantir Technologies. We're focusing on a really dynamic period, the week spanning May 30th to June 5th, 2025. We've gathered up articles, reports, financial updates from that specific window to, cut through the noise and figure out what truly mattered for this company and, well, for you investors.
Yeah, that week was a real snapshot of Palantir's current state, kind of a mix of powerful forward momentum and some significant cautionary flags. The stock saw major moves, definitely driven by strong fundamentals, but the whole conversation around its value really intensified. Our goal here is to distill the most important points.
Okay, let's start by unpacking that positive momentum. It was pretty undeniable. If you were following PLTR during that week, you saw the stock trading right up near its 52-week high. And looking back, the performance has been, well, incredible returns of around 490% over the past year. Huge numbers.
And just in 2025 alone, we're talking about roughly 75% growth year-to-date. On May 30th, it even touched a new all-time high, $132.04. I mean, that kind of trajectory demands attention.
Absolutely. And what was fueling that impressive climb? A major driver, according to the reports, was the company's strong financial performance in Q1 2025. Palantir reported revenue of $884 million. It represents a 39% increase compared to the same quarter of the previous year.
That Yahweh growth.
And importantly, that figure beat market expectations by $21 million.
So they didn't just grow, they grew more than analysts expected.
Precisely. And the profitability picture also improved significantly in Q1. Net income more than doubled, reaching $214 million.
Wow.
Seeing both top-line revenue growth and bottom-line profit expansion is, well, it's a potent combination for investors.
Adding to the positive outlook, the company actually raised its full-year revenue guidance, suggesting they see this strong performance continuing.
The sources really pinpoint the U.S. market as a key engine. We saw figures showing U.S. commercial revenue surging by a remarkable 71% year over year.
71%? That's huge.
While U.S. government revenue wasn't far behind, growing to 45%. That kind of acceleration, particularly commercial, is sort of a newer story for them, isn't it?
It is. They're historically known for government work, but that government growth was also specifically highlighted with more detail. Reports mention the increasing adoption of Palantir's platforms, particularly their Foundry tool, across various U.S. federal agencies.
Like who?
Well, we're talking critical areas like the Department of Homeland Security and Health and Human Services expanding their use. The fact that these essential government bodies are deepening their reliance on Palantir's software, that's a significant signal of its utility and maybe its stickiness.
And like you said, it's crucial to note it's not just government anymore. The commercial momentum is incredibly important.
Yes.
Reports during that week, around June 5th, detailed several new strategic partnerships. They announced collaborations like one with Bolt.
Right, for e-commerce payments.
Aiming to integrate Palantir's AI into their system for an AI-powered Checkout 2.0. Another partnership was with teletracking.
Healthcare operations.
Using Palantir's AI platform, or AIP, to bring AI insights into hospital management.
These examples demonstrate how their core AI platform is finding applications across very different industries. That speaks to its potential for wider adoption.
And financially, beyond just revenue and profit.
Looking at the broader financial health, the information pointed to strong underlying stability. While, yes, some areas like R&D and sales still have high costs, a key metric noted was a very healthy operating cash flow margin.
Okay, what was that?
42.8%. Operating cash flow margin is basically a measure of how efficiently a company turns its sales into actual cash that's available for reinvestment or paying down debt. A high margin like that indicates the core business is generating cash effectively.
Now, here's where the conversation gets really interesting and perhaps a bit more challenging for you as an investor considering this company.
Right.
Despite all that powerful momentum we just discussed, the revenue beat, profit growth, exciting partnerships, the information you shared universally flagged a major point of caution: valuation.
That's the critical balancing act the market is grappling with. While the growth is strong, the analyses consistently described Palantir's valuation as high or even a burden.
Let's talk numbers.
The multiples cited were significant. Some sources pointed to it trading at over 75 times its estimated 2025 revenue and a staggering 175 times its estimated EBITDA.
Whoa, those are big numbers. Can you quickly break down what EBITDA is again and why those multiples are considered so high?
Good point. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's basically a measure of core operational profitability.
Right.
Investors look at multiples like price to EBITDA or price to revenue to see how the market's pricing the company relative to its performance now.
Yeah.
When a stock trades at, say, 75 times revenue or 175 times EBITDA,
Sure.
it suggests investors are paying a very high price today based on expectations of massive future growth. It implies a huge amount of optimism is already baked into the current stock price.
Got it.
Other sources offered slightly different but still elevated multiples, like 18.5 times forward revenue, that's expected revenue over the next 12 months, and 50 times free cash flow. Regardless of the specific metric, the consistent message was that the price-to-fundamental ratios were very stretched.
So with that picture, strong fundamentals and a very high price tag, what were analysts saying, according to the info you shared?
Well, the analysis highlighted a divergence in opinions, which is, typical, but with a noticeable lean towards caution.
How so?
Many analysts were noted as maintaining a hold or neutral rating on the stock even after those strong Q1 results.
Interesting.
And interestingly, many of the price targets cited were actually below the stock's trading price during that week. Ranges like $70 to $100 were mentioned. Some targets were raised, maybe to $110 or $130, but still.
Suggests they didn't think it was a buy right then.
It suggests that even analysts who saw the improved performance weren't necessarily convinced the stock price warranted a buy at its current level. However, there were more bullish takes. Loop Capital, for instance, was cited with a buy rating, pointing to the strong fundamentals and execution. But then on the flip side, RBC was mentioned with an underperform rating, likely due to those valuation concerns outweighing the positives.
What about activity from people inside the company, insider sales?
Yes, insider activity was noted. The sources mentioned co-founder Stephen Cohen had made significant stock sales earlier in the year, February-March timeframe.
Okay.
More recently, specifically during this week, the chief accounting officer also sold shares. But it was important that the sources provided context for this latter sale,
Which was?
clarifying it was for tax withholding purposes related to vesting restricted stock units, or RSUs.
Oh, standard procedure sometimes.
Exactly. RSUs are common compensation. When they vest, a portion is often sold automatically for taxes. The sources framed this sale as regular, non-discretionary, distinguishing it from, say, sales that might signal a lack of confidence.
Gotcha. Beyond valuation and insider moves, what other potential headwinds or risks did the sources point out?
Several other factors were mentioned. One is just the potential for short-term stock price volatility, especially after such a rapid run-up.
Makes sense.
The sources noted even during this week, there was a 3% dip on June 4th, partly attributed to profit-taking. Investors locking in gains.
Okay, what else?
Another point was uneven regional growth. While the U.S. is strong, there were suggestions that performance, maybe market penetration in Europe, might not be meeting expectations. That could drag on overall global growth. Broader macroeconomic headwinds were also listed as a risk. If the economy slows down significantly, corporations might cut back on spending, maybe including new AI implementations.
Which could hit Palantir's commercial growth.
Potentially, yes.
And given Palantir's history, politics and past controversies often come up, right? Did the sources mention that?
They do. The reports specifically noted that Cathie Wood's ARK Invest-selling shares earlier had been reported in the context of these surveillance program controversies.
Interesting connection.
So while the sources don't take sides, they acknowledge these as potential external factors that could impact the stock.
Anything else on the risk front?
Finally, yes. Despite the strong revenue growth, the sources reiterated that operating margins, while improving, are still lower than some comparable software companies.
Why is that?
Partly due to high costs in R&D and also sales investments needed to land those big contracts. Also, historical data was cited suggesting Palantir's stock has sometimes shown more vulnerability during broader market downturns.
Okay.
A company that is currently executing well and benefiting from significant tailwinds. There's undeniable momentum.
Right.
Strong growth in key U.S. markets. Financials beating expectations, expanding partnerships, showing tech versatility, and high demand reported for their AI platform, AIP.
But, and it's a big but, that exciting growth story comes packaged with significant considerations for anyone interested in the stock.
Exactly. The most prominent caution flagged across the sources is that very high valuation, meaning it implies the market has already priced in a substantial amount of future success. This high price tag, coupled with those specific risks we discussed, volatility, regional performance variations, macro impacts, political scrutiny, margin pressures it requires investors to approach with a clear understanding of the downsides as well as the upsides.
It feels like the core challenge presented by these sources is figuring out how to weigh that compelling growth potential against the significant price you have to pay today and, well, the potholes that could appear.
It is. I think the key takeaway we can distill from the material is that while Palantir's fundamental business appears strong and their growth trajectory, investors must critically evaluate whether the current valuation level is justified and sustainable. They need to watch closely how successfully Palantir continues to expand market penetration of their AI tech globally, and importantly, their progress towards improving overall profitability margins, not just growing revenue.
Given this powerful mix of strong performance and growth highlighted in the sources, alongside those equally strong warnings about valuation and risks, how do you personally weigh that balance between Palantir's potential and the price the market is currently asking?
It's certainly a situation that demands careful thought and analysis, looking beyond just the headlines. Yeah.
Thanks for joining us for this deep dive into Palantir's recent news. We really hope breaking down these sources helps you feel much more informed about that busy week and what it signifies.